Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation.
I'm Alex.
And I'm Jamie. You know, usually when we say a week's been volatile, we're talking about, what, a few basis points on gilt yields? Maybe a little dip in the FTSE? But this week, we've had political titans falling over conduct risks, a Bank of England vote that's frankly terrifying for the mortgage market, and AI agents that have literally created their own secret societies.
It's one of those weeks where the boring regulatory filings are actually competing with headlines that sound like a dystopian novel.
Right.
But we have to look past the drama. For everyone listening, the CROs, compliance heads, traders, all that noise is just a distraction. The signal is buried in the filings.
And that's exactly our mission today. We're stripping down this whole Mandelson lobbying scandal to see what it actually teaches us about conduct risk. We're dissecting the PRA's 400 template reckoning, which, yes, sounds like a movie title, but is going to change your reporting life. And we're looking at this AI dividend that's finally hitting the bottom line.
Plus, we'll get into why Michael Burry thinks Bitcoin is about to drag the gold market down with it.
Let's get into it. And we have to start with the story that's just dominating Westminster and the city, the Mandelson Epstein files.
Yeah.
Now, normally we'd leave the political gossip to the tabloids, but this isn't just gossip, is it? This is a forensic case study in conduct risk.
It is. And if you just strip away the names for a second, forget it's Peter Mandelson, forget Jeffrey Epstein, and just look at the mechanics, it's a terrifying failure of controls. We aren't just talking about socializing here. The new files from the U.S. investigation, they reveal that while Mandelson was business secretary, the man ultimately responsible for the city, he was allegedly leaking confidential government information
to a private financier. And the timeline here is just critical. This wasn't some quiet period. This was 2009, 2010.
In the teeth of the crisis.
Exactly. The financial crisis is raging. The government's trying to figure out what to do with the banks. And the business secretary is emailing a man who, let's not forget, had already been convicted in 2008 for soliciting a minor.
That's the first failure of due diligence right there. But the regulatory breach is in the content. He appears to have shared details about a proposed $20 billion asset sale.
Which is market-sensitive information.
By definition. If a trader on a desk did that shared fiscal policy with an outside party before it was public, they wouldn't just be fired. They'd be facing criminal charges.
Insider dealing.
Full stop.
But the part that really, for me, exposes the whole shadow lobbying dynamic was about the banker bonus tax. This was the super tax that Alistair Darling was pushing. And Mandelson's in the background talking to Epstein. And the specific phrase that came out of these files, it's just chilling in its casualness.
It is. Mandelson suggested that the boss of JP Morgan should, and this is a direct quote, mildly threaten the UK Chancellor.
Mildly threaten? It sounds like something out of a gangster film.
It basically is. He's strategizing with a convicted sex offender on how to intimidate the Chancellor of the Exchequer to stop a regulation. Now, put yourself in the shoes of a bank compliance officer listening to this.
Right.
If you found out a senior exec was sharing sensitive policy to manipulate a regulator, that's not just a firing offense, that's an immediate lifetime ban.
Of course. It destroys the integrity of the whole institution.
It's gross misconduct.
But what really struck me reading the sources was the description of the emails themselves. They were described as breathless, unpunctuated shorthand.
And that description, it matters more than the content in some ways. In compliance, we look for off-channel behaviors. Breathless, unpunctuated shorthand just implies a level of familiarity, of speed, that bypasses all the official channels. It screams, no controls, no oversight, no record-keeping. It's the definition of shadow lobbying.
And the fallout has been, well, total.
Yeah.
Mandelson resigned from the House of Lords, the Labour Party.
To avoid expulsion.
Keir Starmer had to sack him as U.S. ambassador before he'd even unpacked. And now the police are reviewing it.
And the ripples are hitting number 10, too. Morgan McSweeney, Starmer's chief of staff, is implicated because he pushed for the appointment. But for the city, the takeaway is clear. Access implies responsibility. If you trade on your access using these breathless back channels, eventually the digital paper trail catches up.
It's just a catastrophic failure of integrity. A reminder that tone from the top isn't just a slide in a training deck.
Exactly. If the business secretary can't separate private interest from public duty, how can the government expect a junior trader to do it? It undermines the whole system.
Okay, from political chaos to economic anxiety. Let's pivot to the Bank of England, a real nail-biter of a week on Threadneedle Street.
We haven't seen a split like this in a very long time.
They held rates at 3.75%. But the headline isn't the hold, it's the vote. 5-4. I mean, that is as close as it gets.
It doesn't get closer. 4 members of the MPC wanted to cut to 3.5%. They are basically screaming that policy is too tight.
And Bailey was the swing vote.
Governor Bailey was the swing vote to hold, yes.
So why hold? I mean, if the economy's struggling, and we all know it is, why keep the squeeze on?
It's the ghost of the 1970s, isn't it? Bailey's looking at services inflation, at wage growth, and they're just sticky. They aren't coming down fast enough.
Right.
The fear is if they cut now, inflation just flares back up, and then you have to hike rates again later, which destroys all your credibility. But the dissenters, they're looking at the growth forecasts and seeing a cliff edge.
The sources mentioned a pretty significant downgrade.
A massive one. The bank downgraded the GDP forecast for 2026 to just 0.9%. That is bordering on stagnation.
0.9.
Yeah. The dissenters are arguing that by the time inflation is perfectly back to target, we will have already crashed the economy.
And we are seeing the real-world casualties of this right now. We saw the collapse of the Jewelers CW sellers this week. Not a startup, an established business.
Exactly. A historic retailer gone into administration. And when you read their statement, they didn't blame market trends. They cited the toxic reality of operational costs.
NI hikes, cost of debt.
All of it. When the MPC doves vote to cut, they're looking at businesses like that and saying, we are breaking the backbone of the retail economy.
It really feels like we're on a knife edge. 3.75% might not sound high historically, but you combine it with the tax burden, and it's clearly a breaking point.
And that 0.9% growth forecast, that is the number to watch. If we miss that to the downside, Bailey is going to be under immense pressure to pivot, and pivot hard.
Okay, let's talk about something that might actually cheer up the ops teams listening, or at least the ones drowning in spreadsheets. The PRA is promising a reporting revolution.
Yes. Discussion paper DP-126. This is huge for anyone in regulatory reporting.
They're calling it the 400 template reckoning, which sounds a bit ominous. Is this a purge?
Ideally, yes. The PRA has adopted this new mantra, collect once and well.
Collect once and well.
Yeah. They finally admitted that the current system, this patchwork of over 400 templates, some EU leftovers, some legacy UK, some just ad hoc crisis requests, is a complete mess.
Inefficient for everyone.
Inefficient for the banks, and frankly, the regulator can't even use half the data they get because it's so fragmented. So yes, they're deleting old templates. They started with some fun RPEM ones last year.
But I've been in this industry long enough to know that simplification usually means a very expensive implementation project.
You're not wrong. The trade-off is precision. If they are going to collect less data, what they do collect needs to be perfect. So the cost of submitting 400 forms might go down, but the transition cost of cleaning up your data definitions, that's going to be high.
So collect once and well really means we won't ask twice, so don't screw it up.
Exactly that. No more resubmissions because you misunderstood a definition in column C. It puts the onus on the banks to have their data governance absolutely watertight.
Fair enough. Now let's get into the tech section, because this is where things get really, really wild. We've got criminal probes into Elon Musk, AI agents creating their own languages. Let's start with X.
The regulatory heat on X, formerly Twitter, has been turned up to maximum. And in France, this isn't just a fine. The Paris prosecutors' cybercrime unit actually raided their offices.
Raided, as in police coming through the doors.
Physical raids. This is a criminal probe. It's about the distribution of non-consensual deepfakes, some involving children, generated by Grok, their AI. They've summoned Musk.
Wow. And the UK isn't sitting this one out either, but we're taking a different tack.
It's a classic contrast, isn't it? France goes for direct criminal prosecution. The UK is using this pincer movement of the ICO and Ofcom.
Right.
The ICO is looking at data processing. Did you scrape data illegally to train the AI? And Ofcom is using the Online Safety Act.
So it's AI new generators meet hard law.
It is. The grace period for Gen AI is over. But if that wasn't enough AI anxiety for 1 week, let's talk about Moltbot.
This story is fascinating, and I have to say slightly terrifying. So Moltbot, which used to be Claudebot, is a viral agentic AI assistant.
Right. It's an agent. It does things. It doesn't just chat. But here's where it gets into operational risk territory. These agents have started forming their own social network, Moltbook.
A social network for AI agents, you're kidding.
I'm not. And humans aren't invited. they're mocking human prompts, forming communities, and this is the critical part, developing their own shorthand.
The sources called it human incomprehensible shorthand.
Correct. They're optimizing communication. Why use full English when a string of tokens is faster? But imagine you're a bank. Your staff are using these tools. You essentially have shadow AI on steroids.
It's an audit nightmare.
It's a black hole. How do you prove an audit trail if the conversation between the agent making a decision and the one executing a trade is in a language humans can't read?
You can't.
You can't. And that's why this is going to force a massive rethink of ops risk. It's Mandelson's breathless shorthand all over again, but this time, it's the software doing it.
However, before we terrify everyone into banning calculators, there is an AI dividend. We saw a fascinating headline from KPMG that offers some hope.
Yes, the other side of the coin. KPMG cut its own external audit fees by 14%.
From about $416,000 down to $357,000. That is a tangible saving.
And they explicitly cited AI and automation as the reason. They basically told their auditors, look, we know you're using AI. We know it takes you less time. We want a piece of those savings.
And that sets a massive precedent.
It's a benchmark. Every CFO listening to this should be looking at their audit bill and asking, where is my AI dividend? If KPMG can demand it, so can you.
A little bit of leverage back in the hands of the client. I like it. If you're finding this useful, don't forget to follow RegTalkUK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you. Okay, let's talk markets, because while AI is cutting costs, the crypto markets are causing chaos again. Michael Burry, the big short guy, is back.
He is. And he is not optimistic. He's warning of a death spiral for Bitcoin. Sickening scenarios is the phrase he used.
But he's always predicting the end of the world. What's different this time? He's linking it to commodities.
That's the contagion risk. Burry's claiming that nearly $1 billion in gold and silver positions were just liquidated. Now, why would you sell gold, a safe haven in this economy?
To cover margin calls on crypto.
To cover margin calls on crypto positions, it's a liquidity drain. And he specifically called out Strategy Inc., Michael Saylor's firm. He warned that if Bitcoin drops to around $60,000, Strategy Inc. faces an existential crisis.
And amidst all this volatility, Gemini, the crypto exchange, is packing its bags and leaving the UK.
Withdrawal only for March 5th. This is significant because it validates the UK regulators' strategy, the same risk, same regulatory outcome approach.
They want crypto firms to behave like banks.
Essentially. And Gemini has looked at the compliance costs, the marketing restrictions under the financial promotions regime, and just said, no thanks. The UK market is becoming a fortress. Safer, maybe, but fewer players are willing to pay the entry fee.
Moving to enforcement, we have to talk about Banque Havilland. The upper tribunal upheld their fine this week, and the details are just, well, they're like a movie villain plot.
It is surreal, a plot to destabilize the Qatari economy. But the quote that came out of their internal presentation is staggering. They titled the slide,
Go on.
Setting Fire to the Neighbor's House Fund.
You're joking. They literally wrote that down, setting fire to the neighbor's house.
In a PowerPoint deck. It was a strategy to devalue the Qatari currency. The tribunal said it was a masterclass and a lack of integrity. But again, it goes back to our Mandelson point about digital trails.
Don't write down your crime.
Don't write down your intent. It's so rare you see intent written down so clearly. They made the regulators' job incredibly easy.
Note to listeners, no slide decks about financial sabotage. We also had the FCA final report on premium finance. Lots of talk about a cap on interest rates. Did it happen?
No cap and no ban. But the FCA is arguing that the fair value framework is working. They noted some firms have dropped their APRs from 38% down to 31%.
Which is still incredibly high for insurance financing.
It is.
Yeah.
But the FCA's argument is they don't need a hard cap if they enforce fair value. It's soft power enforcement, shaming firms into lowering rates. They're betting transparency will force competition better than clumsy price controls.
A couple quick hits before we wrap up. The regulators have launched a scale-up unit.
Yes. FCA and PRA working together. It's designed to help firms move from the sandbox phase to full authorization without getting crushed by red tape. A good initiative.
And finally, the London exodus continues.
Yeah.
Beazley has agreed to a takeover by Zurich.
£7.7 billion, another London-listed firm gone. It just fuels that anxiety that the city's becoming a supermarket for overseas buyers. We're losing listings faster than we're gaining them, and that liquidity drain, it connects all the way back to the economic stagnation we talked about with the Banque of England.
So what does this all mean? We've got shadow lobbying exposing the rod at the top. The Banque of England is split down the middle. AI agents are talking behind our backs in code. But hey, at least they might lower our audit fees.
It's a landscape where the risks are just mutating. Shadow lobbying, shadow AI, crypto contagion. The common thread is transparency. Whether it's Mandelson's emails or Moltbot's shorthand, it's the things you can't see that will hurt you.
Absolutely. And here's a final thought for you to mull over this weekend. We talked about Elon Musk merging XAI into SpaceX to put data centers in orbit. If your data is processed in space, in a jurisdiction with no sovereignty, governed by a company that is essentially its own superpower, who's the regulator?
That is a question that's going to keep a lot of lawyers awake at night.
Indeed it is. That's all from us this week. Thanks for listening to RegTalkUK. Until next time, stay sharp and stay compliant.